Over the years, I've seen markets soar and crash, bubbles inflate and burst, and investors get caught off guard because they believe the headlines instead of looking at the underlying fundamentals. Today, I want to share with you the hidden reason the stock market is still standing and why it won't last much longer. You've probably seen the S&P 500 up yet again, corporate earnings looking solid, and pundits celebrating another year of double-digit gains. But here's the thing, all of this strength is largely an illusion. The market isn't rising because the economy is robust. It's being propped up artificially by buybacks, passive investing flows, and liquidity injections from the Fed. These are supports that have been effective for a while, but they're fragile. And when they start to crack, the market could face a much more dramatic correction than most people anticipate. Take a look at 2025. The S&P 500 has been up 17% despite geopolitical tensions, trade disputes, and uneven economic growth. Analysts are divided. Evercore is bullish, forecasting 9,000 by 2026, which would represent a 30% upside, while Morgan Stanley is bearish, predicting a drop to 4,900, a 30% downside. Both outcomes are plausible because the market isn't being guided by fundamentals. It's being guided by flows, hype, and corporate financial engineering. This is the environment investors are operating in, and unless you understand these forces, you're likely to be blindsided when the facade crumbles. Let's start by examining the artificial supports that have kept the market elevated. Corporate buybacks have been a major factor. Companies aren't necessarily buying back shares because they see untapped growth opportunities or believe their stock is undervalued. In many cases, they're borrowing money to buy their own shares. This creates a cycle of financial engineering, borrowing at low interest rates to reduce share count, boost earnings per share, and prop up stock prices. The effect is immediate on the market, giving investors the impression that everything is healthy. But it's not sustainable. Buybacks can't continue indefinitely, especially if economic conditions worsen or credit markets tighten. When companies stop buying back shares, the automatic support for stock prices disappears. Then there's passive investing. Index funds, ETFs, and retirement plans like 401s have created a tsunami of automatic buying. These funds pour money into the market regardless of valuation or underlying fundamentals. As a result, even stocks that are fundamentally overvalued get purchased simply because they're part of an index. This isn't necessarily a problem in the short term, but it creates a concentration risk. A handful of mega-cap tech stocks, often referred to as the Magnificent Seven, are now driving the entire index. AI hype has further inflated valuations in tech, and passive investing ensures that money continues to flow into these companies automatically. If sentiment changes or a catalyst triggers selling, these stocks could experience outsized declines, dragging the broader market down with them. The Federal Reserve has also played a role. While quantitative tightening is underway, the Fed's balance sheet remains elevated. There is still liquidity in the system that supports asset prices. This excess liquidity makes it easier for buybacks to continue and for companies to finance themselves cheaply. The result is a market that appears resilient on the surface, but is actually propped up by artificial demand. Investors often mistake this artificial demand for underlying strength, which is a dangerous assumption. Meanwhile, fundamental indicators are deteriorating. Price-to-earnings ratios are historically high, meaning stocks are expensive relative to earnings. Corporate debt levels are near record highs, leaving companies vulnerable to interest rate spikes or credit market disruptions. Earnings growth is slowing, consumer spending is weakening, and commercial real estate losses are starting to hit bank balance sheets. Small-cap stocks, which are typically more sensitive to economic cycles, have already entered bear market territory. In other words, the market is fragile. It's not a matter of if a correction will happen, it's a matter of when. Now let's talk about the catalysts that could trigger a collapse. A recession would be the most immediate factor. During a downturn, passive funds could be forced into selling as investors withdraw money from retirement accounts or funds rebalance in response to market pressures. Buyback programs would almost certainly halt, removing one of the key artificial supports. AI hype, which has been a significant driver of tech valuations, could deflate rapidly if the promised returns fail to materialize. Geopolitical shocks, whether involving Taiwan, the Middle East, or renewed trade wars, could exacerbate declines, especially if investor sentiment is already fragile. A Fed policy misstep, such as cutting rates too late or too early, could amplify volatility. And if credit markets seize up, companies could struggle to finance themselves, further pressuring stock prices. All these factors point to the same conclusion. The current market strength is misleading. Investors are being lulled into complacency by rising stock prices, but those prices are being held up by forces that will eventually vanish. When they do, the market won't just correct gradually, it could experience a sharp and severe decline. This is not fear-mongering. It's an analysis based on observable trends and historical patterns. The financial engineering we're seeing now has precedents. Similar situations have occurred in the past, where markets appeared strong on the surface, but were structurally vulnerable. When the artificial supports disappeared, the resulting market reactions were swift and painful. Understanding this dynamic is critical for anyone participating in the market. Blindly buying stocks because the S&P 500 is hitting new highs is no longer a safe strategy. Instead, investors need to focus on risk management, diversification, and valuation. Don't assume that because the market is up, the economy is strong or corporate earnings are solid. Look under the hood. Examine balance sheets, debt levels, cash flow, and the sustainability of buybacks. Pay attention to macroeconomic indicators that could signal weakening fundamentals. Evaluate your exposure to high concentration sectors like mega-cap tech stocks, where passive inflows have inflated prices disproportionately. From a strategic standpoint, there are several approaches investors can take to protect themselves. First, consider hedging or reducing exposure to overvalued segments of the market. If your portfolio is heavily weighted in passive funds or tech megacaps, think about reallocating to more stable, dividend-paying stocks or sectors with stronger fundamentals. Second, keep cash reserves or short-term investments available to capitalize on opportunities when the market inevitably corrects. Liquidity is a critical tool during downturns because it allows you to buy quality assets at discounted prices. Third, adopt a long-term perspective but remain flexible. Don't become emotionally attached to positions just because they've been performing well. Instead, continuously reassess risk in light of changing fundamentals. It's also worth considering the behavioral aspects at play. Many investors rely on narratives rather than data. Headlines proclaiming rising stock indices create a sense of security, even if the underlying metrics don't support it. Human psychology tends to overweight recent performance, and fear of missing out drives money into already inflated assets. This is why passive flows can sustain markets longer than fundamentals would suggest. But it also means that when sentiment shifts, the impact is amplified. Understanding these behavioral tendencies can help you make more rational decisions and avoid getting swept up in artificial market momentum. Furthermore, the interplay between buybacks and passive investing creates a feedback loop. Buybacks support stock prices, which drives index fund valuations higher. Index funds then attract more capital, further elevating stock prices and reinforcing the cycle. This feedback loop masks risk, and when one element falters, such as a slowdown in buybacks or a sudden withdrawal of passive inflows, the loop can reverse violently. Being aware of this mechanism allows investors to anticipate potential inflection points and adjust positions proactively. AI hype is another factor to watch closely. It has driven valuations in technology stocks beyond what fundamentals would justify. Investors often assume that AI will generate massive profits immediately, but technological adoption takes time, and monetization paths are uncertain. When expectations aren't met, rapid sentiment shifts can occur, triggering sharp declines. AI isn't inherently a bubble, but the market's perception and pricing of AI-related companies may be, and that discrepancy creates risk. Liquidity in the system, while still elevated, cannot remain infinite. Central banks have tightened policy in recent months, but the effects are lagged. Many companies and investors continue to operate as if credit conditions are benign, borrowing to buy back stock or leverage positions. When tightening fully permeates the system, interest costs rise, credit becomes harder to access, and financial engineering strategies falter. Investors should monitor credit spreads, borrowing costs, and central bank signals to gauge when liquidity support may be waning. So what should an investor take away from all this? First, don't rely solely on market indices to measure risk. The apparent strength may be artificial. Second, diversify holdings and consider allocation to assets that are less sensitive to artificial market supports, like high-quality dividend payers, inflation-protected securities, or cash equivalents. Third, remain vigilant regarding valuations, particularly in sectors with heavy hype or concentrated ownership. Fourth, plan for volatility. If you're unprepared for a sharp correction, even strong fundamentals won't protect you from emotional and financial losses. But let me go even deeper, because to really understand why the market still appears strong, you have to understand the psychology behind it. Markets don't move because numbers change. They move because beliefs change. Investors today believe the Fed will always step in. They believe companies will always buy back shares. They believe passive flows will always keep pushing the market up. They believe AI will keep delivering never-ending gains. And beliefs, especially collective ones, are powerful. They can keep a market elevated far longer than fundamentals justify. But when beliefs break, they break violently. I've seen this repeatedly in my decades working in fintech and banking. Once sentiment snaps, no amount of spin or optimism can stop the sell-off that follows. What's happening right now reminds me of the late stages of the dot-com bubble. Back then, too, you had companies with sky-high valuations because investors believed they would dominate the future. They weren't profitable, their balance sheets were terrible, but that didn't matter until it did. The moment investors began asking tough questions about earnings, business models, and sustainability, the entire narrative collapsed. Today, we're seeing something similar with AI. Don't get me wrong, AI is transformative. It's going to change industries. But the valuations being assigned to AI-exposed companies right now assume decades of hypergrowth with no obstacles, no competition, and no macroeconomic risk. That's not how markets work. Eventually, reality has to catch up. This ties back to passive flows. Most people don't realize how mechanical the system has become. Money automatically goes from paychecks into retirement accounts, then into index funds, which then buy the same stocks again and again, based simply on market cap weight. It doesn't matter whether a company is overvalued. If its market cap grows, the index buys more. That's how you get distortions, where a small number of companies dictate the direction of the entire market. But think about what happens when money starts leaving the system instead of entering it. What happens when millions of investors panic and start withdrawing cash? Passive flows don't buy. They sell. And they sell everything indiscriminately. Not because the stocks are bad, not because the fundamentals change, but simply because the mechanism requires it. There's also the demographic factor. Baby boomers, the largest investing cohort in history, are entering retirement. As they shift from accumulation to distribution, the natural direction of money flow changes. Instead of buying more equities, many will start selling to fund retirement. You combine that with market fragility, overvaluations, and corporate debt burdens, and you have a setup where passive outflows can trigger a cascade. People think passive investing reduces risk, but in a downturn, it actually amplifies it. When everything sells at once, good stocks, bad stocks, overpriced stocks, undervalued stocks, the entire market becomes a single trade. Let's also address the issue of buybacks more deeply, because this is one of the most misunderstood factors. Many investors view buybacks as a sign of confidence, but in the last decade, buybacks have shifted from value-based decisions to engineered strategies. Companies buy their own shares, not because the stock is attractive, but because it's the fastest way to boost EPS metrics, which then trigger executive bonuses. So it's not just a financial engineering problem, it's a corporate incentive problem. When executives are rewarded for short-term stock performance rather than long-term stability, you create a system where debt is accumulated recklessly just to maintain the illusion of growth. When earnings slow or financing costs rise, buybacks stop first. And historically, markets experience their sharpest declines immediately after buyback programs pause. It's like removing a pillar from a shaky structure. The moment companies lose the cheap credit that funds buybacks, the artificial demand disappears, exposing the true level of investor appetite. And the truth is, without buybacks, without passive inflows, and without AI hype, the appetite is far lower than prices suggest. Look at corporate debt. It's at an all-time high, and not just in quantity, the quality is deteriorating too. A huge percentage of corporate bonds sit just above junk status. If we experience even a mild recession, downgrades could be widespread. Downgrades force institutional money to sell debt they're no longer allowed to hold, which pushes yields up and makes debt even harder to refinance. When refinancing becomes expensive or impossible, companies cut costs aggressively. They lay off workers, halt expansion, stop hiring, freeze buybacks, and slash dividends. All of these actions hit the stock market directly. So corporate debt, which most investors ignore, is actually one of the biggest systemic risks today. Consumer spending weakening is another problem. The U.S. economy is built on consumption, and for decades, consumer spending has been resilient. But now we're seeing cracks. Credit card debt is surging, delinquency rates are rising, and savings levels have normalized from pandemic highs. Wages aren't keeping up with inflation for many households. This doesn't immediately crash the market, but it erodes earnings growth gradually. And once earnings guidance starts getting revised downward consistently, valuations begin to compress. That compression can take a market from historically expensive to historically cheap very quickly, especially when sentiment shifts. Commercial real estate is the silent crisis nobody talks about. Office vacancies are at multi-decade highs, and refinancing waves are coming. When commercial real estate loans default, it doesn't just hurt property owners. It hits banks, especially smaller regional ones. We saw a hint of this with the banking turmoil in 2023, but unlike then, the Fed might not be able to backstop everything without reigniting inflation. If banks take losses, they tighten credit, which slows business activity and increases recession risk. It's a chain reaction. Finally, recognize that while the market as a whole may be at risk, individual opportunities still exist. Companies with solid earnings, manageable debt, and clear competitive advantages are less likely to experience catastrophic declines, even in a downturn. These opportunities require research and patience, but they provide a way to navigate a fragile market landscape effectively. The key is not to chase returns blindly, but to understand the structural factors propping up asset prices and to invest in a way that mitigates those risks. The bottom line is this: the stock market isn't rising because the economy is robust or because corporate earnings are booming. It's rising because buybacks, passive investing, and AI hype are creating artificial demand. These are supports that cannot last forever. When they vanish, forced selling from passive funds, a halt to buybacks, and a correction in AI-driven valuations will likely cause a severe market decline. As investors, we must understand these mechanisms and prepare accordingly. Ignorance is costly, and recognizing the fragility beneath the surface is the first step in protecting your portfolio and seizing opportunities that arise during inevitable market disruptions. Markets always cycle, and understanding the difference between artificial demand and true economic strength can make the difference between surviving a downturn and getting caught in a catastrophic loss. Pay attention to the forces of buybacks, passive flows, AI hype, and liquidity. Monitor fundamentals closely, stay diversified, maintain cash reserves, and don't let headlines dictate your investment strategy. By doing so, you position yourself not only to weather the next correction, but also to take advantage of opportunities that others, blinded by artificial strength, will miss. The market is standing now, but history and data tell us that the support is fragile. Being prepared, rational, and strategic is the best way to navigate what's coming.